Hi, good morning everyone. Welcome to Finbuzz Learning. My name is Piyush and I'm a chartered accountant by profession. And our topic here is, which is very important, in our today's scenario, banking world is liquidity risk. Like what is liquidity? What are its advantages? What is its risk? What are the types of liquidity risk? So let's move on and discuss about that. So moving on the next slide, I'll speak about me, like who I am. Actually, I'm a chartered accountant by profession, and I have a 7 years of experience in finance industry. I qualified in 2017, and I had worked in various industries like banking industry, consulting basis, or statutory audit side. And currently, I am working into EY as an assistant manager into liquidity and transaction services where I am handling US clients predominantly. So moving on, what is liquidity? So let's just talk about what is liquidity. So liquidity in layman terms means, you have sufficient cash available when it is required. For example, if I talk about me, I'm going to a market and I need to buy something. I should have a cash available with me to buy something, or in case somebody asks comes to me and comes to me and asks me that I need the money back which I have taken from him, certain time back, and I should have that availability of funds, to avoid a reputational loss, or because if I don't have money at that point of time, I might be suffering a reputational damages to me. So that is all about liquidity risk. So uh, look at the PPT slide. What it says: liquidity at a high level is the ability of the bank to fund its assets and meet obligation as they come due. So it is the bank's ability that they should have its assets available, liquid assets available, when their obligations come, like short-term liabilities, current liabilities. Whenever the liabilities arise, they should have the availability of cash. So it is all about matching concept. That, for example, if I had borrowed a money for 30 days, I should have available funds with me on that 30th day, because on that 30th day I need to pay that money to that XYZ vendor, you know so it is all about liquidity to essentially fund its balance sheet. And the risk is the firm does not have sufficient financial resources to do this, and cannot secure such resources at a reasonable cost. So it's all about funding, balance. So if we talk about the balance sheet, all of you are professional, or maybe uh, coming from a business background, you must know that what is balance sheet. So in balance sheet, what is we have taken the loans from, for example, you've taken the loan from your father for 30 days. You must be investing in a stock market, and at the end of 30th day, your father must be asking that where is my money. So you must be having that availability of fund at the 30th day, by liquidating your shares or your profits or dividend, any XYZ, to pay back that money. So that is all about liquidity. So liquidity becomes risk when the firm does not appropriately manage its liquidity resources and uses. Sources is all about how you are getting the money from, where, which are the sources from where you are getting the money. For example, debts, subordinate debts, your creditors, your long-term debt, equity, and uses, where actually you're using that money. You are investing, giving the loans to the any wholesale vendor or a retail customer. So that's about uses. So liquidity sources can be differentiated further between the primary and secondary sources. So primary sources, how you are can make the money available with you. So that is all about sources. So it can be from primary sources and secondary sources. So primary is something, very cheaper and easily available funds. For example, your cash money, your balance with the bank, your short-term investments, secured funding, short-term, not short-term investment, short-term funds, secured funding, something which you are easily, can avail that money. For example, government funding, any funding which is easily available. And when you talk about secondary sources, something more complicated. Easy, it is not, comes with a low cost, it comes with a high cost. For example, any long-term debts with a high rate of interest. So all it's about secondary source of funding. So moving on the type of liquidity risk. So what are the types of liquidity risk? How it can be short term, it can be long term, it can be intraday, it can be marketability. So short term is something, for example, I've taken a loan for for about 2 years, 3 years. So I should have that money available after 3 years to pay back my borrower. So that is all long term. LT is long term, strategic. Ability to raise or borrow funds at a reasonable cost to support growth from a structural perspective. This is more of a a business term. Business words are being used, but in a layman term, that's what I have explained you. Tactical or strategic short term funding. Short term is within as when they come due. For example, within 30 days, 60 days, 90 days, within 1 year, to be precise. Whenever they come due within a year, it is a short term funding. Intraday is more, is a regulatory or liquidity risk comes, for example, I have a balance with the Fed banks, Federal Reserve. I am talking on the US perspective. I have a balance with the Federal Reserve, and I keep on making the transaction, like purchasing the securities, buying, getting the securities back, or so my money, the money which is available with the Federal Reserve should be always be positive. It cannot be negative. So, for example, I have given a loan. I have given money of 10,000 to you and asking you to trade the shares for me for every time, and hypothetically the net amount including profit and loss comes out to be minus 100. So I cannot trade the shares next time, or you cannot allow me to trade the share unless until I deposit an amount of 1,000 or 10,000 again into your that account. So that is about intraday. Ability to meet all the payments, clearing settlement obligation at the time expected. In other words, having access to sufficient cash available to maintain a business as usual posture. So that is about intraday. Another component of liquidity risk is the marketability and tradability of assets and security. So at the reasonable cost and certainty. This leads to monetizing held on balance sheet either via liquidity or securitization. So marketability or securitization. Securitization a very broad term. For example, if I talk about I have a debtors in my books of accounts. I have sold those debtors to some company and taken the money from that. So I got the money, and somebody there's a special purpose vehicle who has taken that debtors with me. So on console level, everything get knocked off. That debtors will still win my books, but at console level, at standalone purpose, I have the money. I can regulate or channelize that money into my books. So that is all about marketability. That risk is also important. So that's all pretty much about me. A short video on liquidity risk. For any questions, any discussions, any feedback, please reach out to me on LinkedIn or email. I'll be very happy to answer the question. And please let me know in case have any suggestions or any other topics which you have in mind, or maybe I can help you out on that. Do let me know, please. Thank you so much. Thank you.